We see a lot of guys on YouTube and the alternative media saying that, hey, there's a bubble in the stock market, and a lot of these guys also have turned from saying that, hey, there's a crash imminent to now saying that go long equities. Not this is a shot on these individuals. Could that be a contrary indicator? I don't know. But it's just quite interesting where we see a lot of the guys, including myself, saying that, hey, this thing's a bubble, this thing's going to pop. And there were many red flags that I've noticed before, but let's just analyze some red flags that I've noticed. That doesn't mean we're at the top, it just means that there's some things just making me wary. Even though I'm probably going to trade around the market, I'm going to look at some stocks that are oversold and haven't really rallied that much throughout the year. Let's look at some of these stocks, or let's just look at NYSE margin debt in the S&P. Let's look at the year 2000, right over here. Okay? You have to realize that the red represents the NYSE margin debt, the blue represents the S&P 500. Look at the margin debt over here. And that's in line with the S&P in the year 2000. That's the tech bubble. And then we saw that tech bubble crash, and then 2003 we saw the Fed funds rate go to 1% and the Bush tax cuts, and then the Iraq war market went up. But it was a phony baloney / artificial market. Look at the NYSE margin debt. It climaxed in 2007, 2008. Same thing with the NYSE. Market crashed, and then slowly but steadily you have all these guys back on leverage, and we're getting closer to a top based on these charts. Doesn't mean that this chart is going to reflect what happened in the past, but it could be a decent indicator of what goes on. And it just seems that we're heading towards more margin debt, and then the stock market's going up based on that margin debt. Another red flag in my eyes. And this thing could potentially go higher. I mean, with Janet Yellen, you don't know. She may print 100, 125 billion per month, and this could artificially send the market higher. Who knows? Okay? But that's just one thing that makes me a bit wary, even though I'm going to be, once again, trading around this market, looking for opportunities that are oversold, in my opinion. And now I want to look at the NYSE investor credit and the market. Okay, let's just look at this. So this is showing positive credit balance in the green, and then you want to look at negative credit balance. And if you notice a few things here, investors, they have more negative credit balance when, first of all, the market peaks based on this graph. Look at August 2010, where the market was at, and then look at the tech bubble here. Okay, you have a lot of negative credit balance. Red flag. And those who were savvy enough got out at this point. Now let's look at June 2007, close to the peak where it was in October 2007. Look at that negative credit balance. And now, I mean, and as individuals started to liquidate their portfolios, you had positive credit balance. So if you look at it sometime in March or April of 2009, that would have been a shoot time to get back in. What are you trying to see now? A similar pattern, right? In October 2013. This is as of November 2013, this graph. But look at this. Doesn't this look similar to what happened in August 2000? That doesn't mean that the market has topped, but that's just one thing to note, in my opinion. And then I want to look at one thing from the Daily Gold site. It's the dailygold.com. It's from Jordan Roy Trensman, or Jordan Roy Brin. He's a guest on my program, and he had this one interesting article. Investor Intelligence bull sentiment at 26-year high. The Investors Intelligence survey shows the bull to bear ratio exploding to what is the highest level since 1987. Also, the amount of bears is the lowest since 1987. Not exactly the time to be betting on stock gains over the next year or two. Bullish sentiment is not bearish if it occurs immediately after a bear market. Yet, when it occurs 5 years into a bull run, it is a big warning sign. just like I'm saying, a red flag. This chart goes back to 1999. We checked the archives for the 1987 data, and let me just increase that right now. Let's just look at a few trends now. So the bull to bear ratio, it's peaking right now. And could that be a red flag? Sure. Because when there are many bulls to bears, that means there are more people that have bought. And now, who else can you buy from? That's one thing to note, unless you start to see more inflation, and then as a result, you see asset prices go up. But that is only to a certain degree, because you have to remember in the 1970s, stock market had all this money printing, but stocks went actually nowhere. I mean, there were times where there were bull markets, but then the market went right back down. So another red flag in my opinion. And one more thing that I've noticed that represents irrational market valuation. Let's just look at some PE ratio historical chart. Let's look at the S&P PE ratio, S&P 500 PE ratio. You could look at the chart, okay? And usually you could say the average, like around 20. I mean, if you look at it actually, the current PE ratio, what I was saying, is 20, okay? But if you look at the mean, 15.50, with the minimum of 5.51 and the max of 123.79. So if you want to look at that, 15.50. Okay, now let's look at some stocks that clearly give me a red flag, or clearly, in my opinion, represent a red flag. Now let's look at one stock called LinkedIn. Okay, a lot of people have their professional status on LinkedIn. Okay, it's a good site, right? In my opinion. I mean, I've found contacts through there, and I've contacted them through email, sending them my resume, like big CEO, not CEOs, but like managing directors, and actually some of them were CEOs. And I've managed to crack the market that way and get employment that way. So thank God for LinkedIn, because it helped me find contacts that I could contact, not directly through the site, but on email. But putting that aside, despite how I like LinkedIn, what bothers me with stocks like this, when I see PEs, that's 727.75. That's as of like Friday. And I don't know what yesterday's date was. Let me just check. The 20th, okay? So assuming that they're calculating it correctly on Google Finance, it's 727. You want to look at another one? Let's type in Amazon. And holy crap, that's over 400 bucks. And the PE is 1423.97, okay? So remember, the PE ratio for the historical S&P PE ratio was 15.5. And other PE ratios that I've saw, maybe around 20-ish, right? On the high end. But okay, that's out of whack. PE ratio 1423. Once again, these are not buy or sell recommendations. These are just red flags to me saying that, okay, if the mean or the average PE ratio over 100 some years is roughly 15.5 to 20, and we see ratios 700 with LinkedIn, Amazon 1423, and then this one, this just makes me laugh. Let's look at Starbucks. 5,457 PE ratio? Are you freaking kidding me, man? And then there are people that I follow saying that there's no bubble, you gotta go buy stocks, and who knows, stocks could go potentially higher. Don't get me wrong about that, but this just raises my red flags. And like I told you, what I'm looking for in the stock market are stocks with low PEs that, this is not investment advice, this is just what I'm doing. I'm just looking at stocks that are oversold using some indicators, technical analysis, and then in addition to that, I'm looking at the financials to see if there's nothing that's a red flag there. Looking at the PE ratios, looking to see if there's just negative news. If there's no really negative news, I'm slowly but starting to trade around those stocks. And it just seems that this market is close to peaking. That doesn't mean that we've seen the top, but what I'm saying is it just makes me uncomfortable getting into stocks with whacked out PE ratios or whacked out valuations. Another thing I wanted to mention, something else about the stock market. Those who have had a good track record. I follow Mike's status from time to time. He's an individual with an incredible stock market record. Okay, better than Schiff's. I like Peter Schiff, but Status has a better record than Schiff. And if you look at what Status has been saying, I think to his subscribers, I can't confirm this, but if anyone can, I think he's told his subscribers that December 2013, it's time to get out. That doesn't mean he's gotten the top, but if you look at some of the things that he's said, like, damn, he's shorted all these real estate stocks, Fannie Mae, Freddie Mac, and a bunch of housing sectors or stocks as well. He got in Dow 6000. He did call the commodity bubble, short-term bubble, in 2011. The list goes on and on and on, okay? So I'm looking at guys who have good track records and trying to see where they're at and what they're doing and trying to put it all together. That doesn't mean that I'm going to get it right. It just means that I'm just trying to figure out better ways to get in and out of the market. And once again, this is not investment advice. You got to talk to your financial advisor to subscribe to an A-list newsletter where they talk about strategies on how you could potentially do better in the marketplace than you are right now. So once again, my opinion, I see a lot of red flags, and it just seems that I don't want to be in stocks or other assets where you have out of whack valuations. And I'm just going to tread carefully, or tread water carefully. Anyways, guys, thanks for listening to me, and I'll do some videos later on. Thanks. Bye.